How do I know, or how does one know, if an IUL policy, their policy, is structured correctly? You know, I've been asked this question thousands of times, and if you've watched very many episodes on this YouTube channel or read any of my books, you begin to realize that it's crucial that an IUL policy is structured correctly and funded properly if it's going to perform as a superior capital accumulation tool, that your money is going to grow at the best or the highest net internal rate of return, so that you can average, like we have, 11%, 11.17 in net within 1%. At the end of the day, 10% rate of return cash on cash. Most policies, sadly, you'd be lucky to gross 7 or 8%, but you might only net 1 or 2%. We have had IUL agents that we've audited their IUL policies, and they're shocked that after 30 or 35 years of paying premiums, their cash value doesn't even equal what they paid into it. And they don't realize you have to structure it correctly for living benefits if that's the purpose. So get ready. I'm going to blow you away with some information so that you can make sure yours is structured correctly. If not, you ought to have it audited to make sure you understand this. So I'm going to show you what you can do to correct it and how to find out if it is structured correctly. So I'm Doug Andrew. I've been a financial strategist and a retirement planning specialist now for 5 decades, helping thousands of Americans optimize their assets, minimize taxes, and empower what I call their authentic wealth. Well, if you've watched very many of my episodes on this channel or read very many of my 12 books on this topic, you'll quickly realize that my favorite financial instrument for any long-term goal, such as retirement or college funding for your kids and grandkids, or working capital for your ongoing business or real estate management and properties, emergency funds, estate planning, and at the end of the day, retirement income, my favorite vehicle is a properly structured, max-funded IUL. And so then people go, well, how do I know if my IUL policy is structured correctly? Which is an excellent question. One that I think everybody who owns an IUL should ask. Now, first of all, this is one of the reasons why we created a very elite group of IUL professionals that we train to be able to make sure they structure it correctly or fix the ones that they did not structure correctly so that their clients will not end up cursing the day they ever started one because it wasn't set up right. And so this is called IUL Insiders, and we allow IUL Insiders to use an auditor tool that allows them to audit any IUL policy to see if it's structured correctly to perform as a superior capital accumulation tool, accumulating money, capital, for long-term goals such as retirement and college funding for kids and what have you, okay? And so that's what the vast majority of our clients use IUL for. It's not the death benefit. That's secondary. That sort of comes along for the ride. They use it for what it was created for in the first place by E.F. Hutton, who was the brainchild behind the emergence of Universal Life, and then later on in 1997, Index Universal Life. My clients have always come to me not necessarily wanting or needing life insurance for death benefit. They wanted it for living benefits. They wanted to accumulate their money tax-free, be able to access that money income tax-free, and generate a vehicle that every $1 million can generate a 10% payout, $100,000 a year of tax-free income without depleting their nest egg, even if they live to be 120. And compared to traditional IRAs and 401ks or mutual funds or annuities or whatever, all of those vehicles run out of money based on the same rates of return or even better rates of return because these are tax-free. Now, the key to this is making sure you structure it correctly in the first place. 85% of a successful IUL is determined in the first 15% of the process. It is the structure of it and the initial funding of it, okay? And so what happens many times, an IUL agent is trying to learn how to do this, and so they will submit to somebody who prepares illustrations with their carrier or with their independent marketing organization. It's called an IMO. And they'll say, I have a client who wants to put in $100 a month or $300 a month or whatever. And so that person then goes in and says, we have somebody who wants to put in $500 a month. And then it may dictate the amount of death benefit required, but sometimes they just solve it for target premium, which target premium is just so that in worst case scenario, the life insurance death benefit won't lapse at a certain age, like age 65, okay? That's not maximum funding it. Or even if they understood the guideline single premium, what is called the GSP, they would go, okay, $500 a month is $6,000 a year, and they times that by 11. If you don't know what I'm talking about, then you don't understand even how to structure it correctly, okay? This is under the TEFRA and DEFRA tax citation. So 11 times 6,000, okay, is 66,000. So you would simply plug in 66,000 as the GSP, and you would ask for the minimum death benefit that you can get away with under IRS rules to accommodate 66,000. Now, you can't put in more than 66,000 during the first 11 years. You don't have to take 11 years to get it in there. You could put 66,000 in over the first 5 years, okay? If you're younger, even in the first 4 years, okay? You'd have to stop once you put in 66,000 and what have you, but it would grow if you had it structured correctly so that at the end of the day, 20, 25, 30 years down the road, and then you start turning on income, you should be able to net within 1% of the gross rate of return. If you learn how to diversify and rebalance, you'll take the average return from maybe 8% based on actual historical performance up to 11% or higher like our clients do. Because on annual reviews, we rebalance, we change the indexing strategies. Maybe we even come back to the general account portfolio like in 2002 and 2008 when the market went down. Or we may change to a 1-year point-to-point with no cap, what is called a threshold strategy, like we did in March of 2020, COVID-19, and our clients got credited 61.33%. Okay, that's crucial if you want to move your rate of return to an average, over, double digits, up there around 11%. But if you averaged 11% gross, when you get down the road, 25, 30 years into the policy, and then you start taking out income, and you have $1 million of cash value when you started taking income, you theoretically want to be able to have a 10% payout, $100,000 a year without depleting your million. Well, that's because you're netting within 1% of the gross. If you're averaging 11, you're netting 10, okay? Now, I'm simplifying this right now, but most IUL policies could not do what I just said because they weren't structured correctly in the first place. And so when we audit these, even though some of these policies are owned by IUL agents, they're shocked when we audit their policy and they don't even have enough cash value projected in the policy that equals the premiums they paid into it in 30 years. Do you know that most of our clients, the premiums they put into an IUL policy, they usually maximum fund it within 5 years because most of our clients are 55 to 75 years old. And their cash value grows to equal and exceed the death benefit sometimes by the 11th year. Now, there is no cost of insurance, technically speaking, in the policy. If they die, the insurance company pays out 5% more than their cash value, but their cash value has grown to equal and exceed the death benefit. You can do that as early as 11 years into the policy. But if you don't structure it correctly, it'll take forever or maybe never. And so when we audit a policy, we can tell, did you have too much death benefit? Were you using a different formula? Or here's one of the biggest mistakes that is made. The agent will sell an IUL policy and they say, well, this client's going to start out with $1,000 a month. And even if the person preparing the illustration goes, $1,000 a month is $12,000 a year, times that by 11 years, $132,000, and they take the minimum death benefit. But then the agent goes, well, this client wants to throw in a lump sum of $50,000 or $100,000. Well, all of a sudden, to avoid a MEC, they're worried about a modified endowment contract, which means you won't be able to access money tax-free. It'll be taxable when you access it. And so to avoid a mech, they jack up the death benefit by simply how much life insurance death benefit do I need to have in order to accommodate $50,000 or $100,000 in a lump sum up front. Well, they're not going to keep putting in a lump sum of $100,000 every year thereafter, but they make the mistake of jacking up the death benefit to double, triple, quadruple, 5 times what it needed to be. That $100,000 lump sum should have been spread out over 5 years, maybe $20,000 a year for 5 years by putting it into a premium paying account or a premium deferred account or anything like that many insurance companies provide. And then you solve for the death benefit to accommodate only $20,000 more per year, not $100,000 the first year. That's a huge difference. And so these are the mistakes. There's numerous mistakes that can be made, but you can tell by doing an audit. Okay. And so when we talk about this many times in my books and my YouTube videos, you're structuring the IUL policy so that the money grows tax-free under Section 72E of the Internal Revenue Code, because it's been grandfathered that way for over 100 years. And then you want to be able to access that money income tax-free under Section 7702, okay? And then when you ultimately die, you want it to blossom and transfer tax-free. So you have to not exceed the definition of tax-free life insurance under these 3 sections of the code. And so back in the 1980s, when this was first introduced, they passed in 82 under the TEFRA Act, the Tax Equity Fiscal Responsibility Act, and 2 years later, in 1984, under the Deficit Reduction Act, this is called the TEFRA-DEFRA Corridor. And the TEFRA-DEFRA Corridor basically dictates the minimum amount of insurance required based upon the person's age, gender, and health in order to accommodate the amount of money you want to put into it. But too many agents don't even know how to structure it that way. They have way more life insurance than they need because they're worried about TAMRA. TAMRA is the Technical and Miscellaneous Revenue Act of 1988, and that dictates whether you can pull out the money tax-free or not. And so they get worried about this one, and then they end up taking way more insurance than TEFRA and DEFRA required. And now, if it could earn 8 or 9 or 11, they're only going to net 6 or 7 because they had way more insurance, meaning the costs are way higher than they needed to be. Okay? You want to keep the cost as low as possible, and you want to structure it so that sooner or later, the cash value grows to equal and exceed the death benefit. And now the cost of insurance actually gets cheaper as you get older. You can't believe how many policies. There's no way the insurance is going to get cheaper as you get older. And that's why the naysayers say, I've never seen a policy that gets cheaper as you get older. Well, you haven't seen one structured correctly then to be used for living benefits. So when you understand TEFRA, DEFRA, and TAMRA and how to apply and comply with the amount of money that people want to reposition and put into it, then you're designing an IUL policy like this metaphorical bucket where you're designing it to accommodate the amount of money you want to put in, but only take the minimum death benefit required to accommodate that money, okay? So that all the interest on this is growing tax-free. So what we teach is how to comply with TEFRA, DEFRA, and TAMRA so that if you're a 60-year-old and you want to put in $500,000 into the bucket, okay, TAMRA says, well, you can only put in maybe 20% of that a year. I'm rounding numbers. $100,000 the first year. It could be the first day of the first year, and then $100,000 the second day of the second year, and then third year and fourth year, and 4 years and 1 day into the 5th year, you can put in the $500,000. But you put in $500,000, but the minimum death benefit for a 60-year-old is only like $1 million. You could buy way more life insurance than that with $500,000. That's not the objective. You want the least amount. So you wouldn't believe how many agents don't know that. And somebody wants to put in $500,000 and they end up with $2 million or $4 million of life insurance because they want to put in $500,000 all up front. And the agent goes, oh, we have to avoid a mech. And so then the insurance is 4 or 5 times what it needed to be. And that's ridiculous. So you have to make sure the agent knows what they're doing. The first 15% of the process is structuring it correctly, okay? And so once you do that in compliance with these guidelines, it turns into a tax-free cash cow But if you're wondering if your IUL is structured correctly or funded properly, the first thing I would recommend is that you claim a free copy of this book, The Laser Fund, and you'll understand and see examples of properly structured max funded IUL. Okay. This is actually 2 books in one, and I'll gift you a copy free. You simply go to laserfund.com or click on the link below, and you'll contribute a nominal amount towards the shipping and handling. I require a little bit of skin in the game, okay? But I'll cover the rest of that cost and I'll pay for the book. And I'll fire out a hard copy of this book, which is 300 pages, but it's actually 2 books. This one is about 200 pages, 14 chapters with all the charts and graphs and explanations if you're a left brain learner. If you're more of a right brain learner, you flip it over to this one. This is about 100 pages, 12 chapters with 62 actual client stories. If you want to use your whole brain, the right brain and the left brain, then read the whole book. Now, folks, when you're in there claiming your free copy, if you like to listen and learn or watch and learn, there's audio and video formats available. You can even schedule to learn from a free educational webinar. We teach 90-minute webinars on a very regular basis, weekly. There's no charge. We also do one about every month, which is called Retire by Design, which is about a 6-hour seminar that is incredible, very deep dive, that is a game changer for many people that are preparing for retirement and they don't want to outlive their money. If you want to schedule an appointment with an IUL specialist that knows, absolutely has passed proficiency exams to prove they know how to structure one correctly and fund it properly, you can schedule an appointment with no cost or obligation with an IUL specialist, okay? But really, this is about you and making sure that if you're interested in IUL, set it up correctly in the first place. If you already have an IUL and you want to see if it's done right, you might want to go through this process and then contact us by reaching out to an IUL specialist when you go to claim your free copy and put in there that you want to have your IUL policy audited, okay? And a well-trained IUL specialist will audit it for you, okay, to tell you whether it's structured correctly. And frankly, we do this for tons of actual IUL insurance agents because they begin to realize they didn't know what they didn't know. And they're shocked when their policy isn't anywhere close to being structured the right way, okay? You want to fix that sooner than later. Now, if you're an actual insurance agent and you want to learn, then I would recommend you go to IULinsiders.com and check that out. IULinsider.com/pro. You can understand, you can attend educational sessions where we teach this, and we also, on a pretty regular basis, have IUL challenges to licensed agents to challenge them to learn how to do this right.